Thank you very much. We may be seated. The Governor, Deputy Governors, Directors present, members of the press, ladies and gentlemen, good afternoon. I welcome you to this briefing. As you may be aware, the Monetary Policy Committee was meeting on the 18th as well as on the 19th. And here we are today. The committee will be presenting the decision that they arrived at. I just want to welcome even our online audience. We acknowledge your presence. Allow me at this point in time to introduce to you the people on the high table. We have the governor seated in the middle of the table, and on his right we have the deputy governor in charge of administration, Mrs. Reka Muhango. On governor's left, we have the deputy governor in charge of operations, Dr. Francis Chipimo. And on Dr. Chipimo's left, we have Director of Bank Supervision, Mrs. Gladys Imposha. On Deputy Governor Administration, Mrs. Reka Muhango's right, we have Director in charge of Economics, Dr. Jonathan Chipili. Let me not waste much of your time. At this point in time, I'll just call upon the governor to come and address the briefing. Governor, sir.
Good afternoon, ladies and gentlemen. Let me join Bessie in welcoming you all to this month's quarters briefing. We meet today, I think the surrounding, as Katia has indicated, is one which is very unfamiliar. So excuse me if I stumble as I try to share with you what the Monetary Policy Committee meeting came up with in its meeting, which started on Monday this week. Thank you so much. This is the second meeting this year, but it's focusing on the events of the first quarter of this year. So we look mainly what has happened since the end of last year up to the present time, but with a focus on the 3 months of the year. So let me just bring up the presentation on the screen. We have about 15 slides or items that there are 15 areas that we'll share with you. As always, we'll start by sharing with you the decision that the committee made. Then this time around, we are somewhat front-loading the real economic activities to the presentation, because I think that's where the substance or the major substance of our meeting focused on. Then I'll look at the domestic economic activity and outlook, drawing from the global economy. Then share with you on inflation outturn and the outlook for the next 8 quarters. Then share on the monetary operations, what were we doing or what do we do in between the meetings. Then I turn on to government securities market, followed by interest rates, domestic credit, money supply, fiscal policy, foreign exchange market, selected commodity prices, current account, which is the external sector, then gross international reserves, and I'll conclude on the 15th item. At our meeting, the committee decided to lower the policy rate by 225 basis points. This brings down the monetary policy rate to 9.25%. those of you who are quick at making comparisons, you note that that's the rate that when this committee was first established, we started out with 9.25%. But that's not the reason why we came up with that rate. We came up with that rate for a number of very important reasons. Firstly, it's really the environment which brings us here instead of our usual place where we share these briefings, the COVID-19. We have observed, so have you, and the world over, that COVID-19 is a major shock to the way we live, to our livelihoods. Lives are being lost. Economies have been brought to a standstill. In our case, as you see, there are a number of ramifications that have already passed through, but the process is still unfolding. So we could not ignore that fact that the effects of the COVID pandemic are far outreaching. So we took that as our first consideration, and what can we do to play a role in mitigating that pandemic. So that's one of the key considerations that we took into account in arriving at our decision. Secondly, arising from the same, we see that economic activity has deteriorated quite considerably. From the last time that we met, a lot has changed, not for good, unfortunately for worse. There are some flickers of hope here and there, but on the whole, the story that we see and which we are going to share with you is one of worsened economic activity here in our country, in other countries as well. Third factor that we took into account is that although the path for inflation projection is much higher than was the case when we last met, we see that towards the end of that path, which is after or in the 8th quarter, inflation starts to trend towards our target range of 6 to 8%. That is very important. We also took into account that although this may be the case, with the harvest just around the corner, we anticipate that there will be a better crop output compared to last year, which, as you know, recorded low output, and that resulted in prices of agricultural commodities, notably maize and maize products, to go up quite significantly. So we see this showing that possibility that inflation could actually come down, driven by the food inflation. The other equally important factor that we took into account is that over the time we have already announced a number of measures. For example, we have the targeted medium-term refinancing facility. We have also taken prudential measures to ease the flow of credit to the players out in the market. We have equally rolled out some measures to strengthen the digital payment platforms. I think you recall that we have a a situation where the mobile money service providers, you can now send money up to 150 kwacha at no charge. So that, along with those other measures, needed to be complemented. So we felt that our monetary policy stance should be supportive to these other measures that we as an institution have taken, but of course the government also has taken other measures. So all these must speak to each other in unison in order for us to achieve the objectives that we seek to achieve. Now, having looked at these factors, let's now share what we see going on in the global economy, and then I'll move to the Zambian economy. You note that when COVID-19 broke out, first we didn't even know what this was. There was just a generic name of coronavirus until the WHO identified. So what we're saying is that this pandemic is quite serious. It's unprecedented in a number of ways. I think we have heard about pandemics, we have read about them, but this one, what we see different, I think, is that the global economy is more united this time, more integrated. So the fact that it is more integrated, even what we are talking about today, people are listening in places which previously they couldn't do so, means that whatever happens in one corner of the world, it quickly travels to another part of the world. So that's a different kind of development compared to some of the pandemics that we have heard about in the past. Two, there has been a lockdown of countries, in some cases, of communities, meaning that people cannot move freely, meaning they can also not do their economic activities as they normally do. This is why I think the other aspect I mentioned of trying to scale up digital platforms became very important. We now have become quite familiar of meeting virtually, which we were not doing before. All these have implications on commerce on the ground. So what we see is that the global economy itself, we have already been informed, declined. In fact, it has gone into recession, recording a projected -3%. That is a deep challenge, because last year the global economy recorded a growth of 2.9%. So if it declines to -3%, that's quite a big movement from a plus to the negative. Now, the other thing we note is that this projected growth is based on certain assumptions. Now, if those assumptions do not hold, obviously that projected outcome was not going to be realized. And what we have observed is that there's still some uncertainty to some of those assumptions that underlay those projections. So what you see is, let me show you here graphically. So this is what we see graphically. You note that the global economy was growing along this path. This is 2019, and then COVID-19 hit. If COVID-19 did not hit, this is the path that was projected to be the way the economy was going to follow. But with COVID-19, you see this sharp drop to -3%. Now, this is very steep. Now, the presumption is that this is going to be of a short duration, meaning that very quickly we can bounce back to 5.8%. Now, a lot depends on, firstly, how long this pandemic is going to last. I think you can see many countries are clamoring to open their economies because they think continued closure is going to hurt the economies a lot more. Also, actions obviously have to be taken to ensure that lost business can quickly spring into action. That's why you have this steep V-shape. Should none of those hold, or some of those not hold, we may see this widening somewhat, or even worse still, this going even down rather than up. So this is part of the challenge that we have. Even here home, there's a lot of uncertainty on the projections that have been made. So what we are saying is that this growth has a number of downside risks, which we share with you here. That the possibility of extended pandemic. I think now you are hearing people talking of a resurgence in the rates of the infections and the people getting quarantined and so on. Prolonged supply chain disruptions. I'm sure you know one or two people, or even yourself, you might already be a victim of that, where what you had ordered somewhere is not available. Even here locally, some of the supply lines have been disrupted. Trade, you see that there is emerging this US-China trade war. Before COVID-19, there was some appearance that some harmony was going to be reached or an amicable solution, but you have seen that just the very fact that COVID-19 is traced to have started in China, that is raising issues with other countries, notably the US and I think UK to some extent. Uncertainty about the future of UK-EU relationship. You know that the UK just came out of the European Union, but that separation is still undergoing some discussion, what kind of relationship they are going to have post that separation. So all these, if they materialize, that's why I was saying that this situation could either become U-shaped or much, much worse, that we don't have growth coming out. But I must be quick to say that some of the economies were doing well before the onset of the pandemic, meaning that their structures were quite strong. So those, if this is not prolonged, means that they can regroup and be able to come back into production. But you have seen countries globally come up with a number of packages to stimulate activity in their respective economies. I'll come back to that later on in the presentation for us here. So let me turn now to the domestic economy. Obviously, what is happening at the global economy has ramifications to our own domestic economy. We are interlinked. One of the ways we are interlinked is through trade. One of our major export commodities is consumed by people outside this country. They are the ones who buy that. Notably, China. The Chinese economy is projected actually to decline to 1.26% from the usual 6+% that we have come to know. Now, for an economy of its magnitude to decline, growth to decline that much, it means that the purchasing power that was there is also reduced. That's why there's all these efforts to try and quickly get things moving forward again. So through our export of commodities, we are affected as well. We also do some surveys here in our domestic economy through this survey which we do every quarter as an institution. And what we have observed is that economic conditions have worsened in the first quarter of this year, with the volume of services, new orders, profitability of all these registered historic lows, meaning that they have gone beyond what they were last year, or some cases for many, many years. So this is the worry that we are concerned about. Two, we see that the business conditions, using another indicator or a set of indicators, which this is the Stanbic Bank Zambia Purchasing Power, Purchasing Managers Index, in short PMI, that too shows that private sector sort of deteriorated, business conditions rather, in the private sector are reported to have deteriorated as new orders sharply declined on account of falling consumer spending. Dear colleagues, I think this is a very serious issue that demand is falling. People are not having sufficient purchasing power to buy the goods that they need. That obviously hurts business. So these two publications confirm that the situation on the ground is worse than what it was a quarter ago. Now, when we add this COVID pandemic in our case, we see that we already had a very challenging situation. We had the macroeconomic environment being unfavorable. All you can expect is that this worsens the situation. Indeed, projections so far indicate that our economy is projected to decline to 2.6% in 2020. Last year, we recorded a growth of 1.9%. But importantly also, you should note that we have not had negative growth. Yes, we have had low growth over the past 20 years, but we have not had a decline in growth. We last had this 20 years ago, about 1999. So some of you who were big enough already there can recall what kind of situation we faced in 1999, starting, we may say, from 1997, 1998, which climaxed in 1999. In fact, that's when actually we pushed hard with other cooperating partners, the civil society. If you recall, that's when Zambia actually reached the decision point in 2020. That was because of the pressure that the economy was facing. The mines were down, in the shops there were marked shortages. You go anywhere, you had problems. So this is what we are saying, that this is not a joke, it's a very serious development, that the economy, which was already weak, is weakened further with the outbreak of this pandemic. Secondly, we see that this has more devastating effects in some sectors than others. One of the sectors which is hard hit is tourism. You can imagine flights are not coming in, hotels are empty. Until last week, I think even the restaurants could not operate unless you could do takeaway. that affects not just the tourist operators, but the whole tourist ecosystem is adversely affected. The other one we see is wholesale and retail trade. These cross-border movements were curtailed, which means that those who are making a living from that are now adversely affected. Construction, social distancing, some of the things you can't do them in construction with the social distancing that is to be observed. So that too has been seriously affected. Similarly, manufacturing and mining and electricity sectors. There are many others which are affected, but we cite these as those who are recording worse outcomes so far. In terms of graphic presentation, you see this is what we are saying, is that our economy last year was at 1.9% growth. Now we are projecting that in 2020, 2.6. You can see what I was saying, that we have consistently been coming down, but now accelerated drop. So that is one of the things that we took into serious consideration as we were deliberating as the Monetary Policy Committee. Inflation. We see that inflation pressures mounted, as I indicated. Yes, their inflation path is much higher, but we see that towards the end is trajecting down, but it is not reaching the corridor or the target range. But we are optimistic that should the crop output turn out as good as it is anticipated, some of that pressure could be reduced. But meanwhile, we see that the pressures on inflation were triggered firstly by increases in fuel pump prices as well as electricity tariffs. Then we see the movement in the exchange rate having quite a big impact on the price level in our economy. So we share with you here comparisons. The first column here, we are showing the projections that we had for the first quarter of this year. Okay, if you look at overall inflation, we had projected that it to be 12.2%, but the outcome was 13.15%. The previous quarter, which is quarter 4, it was 11.1%. Food inflation, not much of a difference. The projections for non-food was 8.2%, but the outcome was 11.2%. So this is the major pressure coming from those three main factors. These others is just for comparison to the previous quarters, the end of period. This is the March figure, or March figures, I should say so, and that was those were the December figures. But look, in April, already inflation even went up further to 15.7%. Partly, we see that being driven by lagged pass-through effects. When the exchange rate depreciates, there are some immediate pressures, or when it appreciates, there are immediate kind of impact that they have. But some of that impact is delayed. It comes much later. So that's what we mean by lagged effects here. So graphically, this is what we have seen. I think you have witnessed these presentations here from our colleagues from the statistical agents, central statistical agents, but we are just showing these are the latest figures we have, this is food inflation, 17, non-food, and the overall, this is for April. But you can see the trajectory that they are all rising, but you see the sharp increase here in the non-food inflation. What's the outlook? As I indicated, although the projected path is higher than February MCT to trend towards the upper bound, what are the factors underlying this projection? We note persistently higher the fiscal deficits. This, as we come to the fiscal section, we see that this is getting even tighter because liquidity constraints have resulted in lower revenues being collected. Then we see that the rising external debt service payments. This is why I think as a country we are pressing hard to get some debt moratorium, because if we don't, it threatens to erode our reserves. High production costs, again, this is a feedback loop. That rise in inflation, it tends to show up in prices of other commodities going up, particularly inputs into the production process. Then we have the deterioration in the global economy. I think I did explain there how that affects us. So if this continues, or these are risks, remember, but if they materialize, then we have a worse situation. But the positive side, we are hoping will be improvements in agricultural output. Monetary operations. The Bank of Zambia, one of its primary objectives is to look at or control the inflation, which is the price stability function. But the other equally important function is that of financial system stability. But since we are talking about monetary policy here, really the focus tends to be on the other factor, which is inflation. Now, how do we deal with this? We use our open market operations mainly to kind of control the movement in money in the economy. So we do this by looking at the interbank rate, which is the rate at which commercial banks borrow from each other overnight. So our preoccupation is to try and keep that within the corridor, the policy rate corridor. But what we see is that in the quarter under review, it averaged 12.6.1, which is above that corridor. I'll show you in a minute. This is what I'm talking about. The green line, this is the interbank rate, this one. That's the one. So this is the policy rate. So we have a buffer around that. So the idea is that we must keep this within this corridor to ensure that inflation is also affected in the direction that we want. But what you observe is that this green line was persistently above this. Now, ordinarily, what would have happened is that we would have undertaken open market operations. That means we would have to supply liquidity to the market so that this rate comes down. But we had another challenge during this period. You'll see it later when you come to the exchange rate section, that if we put money into the system, that money, the possibility of it going to the foreign exchange market was very high. So to avoid that happening, we chose to let this lie above that. so that we don't induce a demand for foreign exchange. Because if the exchange rate depreciates quite rapidly, the impact on inflation is quite strong. So that's the balancing act that we try to maintain on a daily basis. Now, this is what we are saying, that despite the elevated interbank rate, the offsetting open market operations were not conducted in order to stem extreme exchange rate pressures. As a result, the rate remained above the upper bound. Now, this chart is also quite interesting because the way it appears here is in a steady state, but on a daily basis, these things are not known, because every morning or different times of the day, colleagues in financial markets have to figure out what liquidity is going into the system and then undertake market operations to guide how this green line is going to turn out. In terms of the actual operations on the ground, I think this is a chart now, a table you must all now be familiar. We opened the quarter with 2.0 billion kwacha into the current accounts of commercial banks, which became the opening balance. Then during the period, there were these net government spending activities. They withdrew 2.3 billion kwacha net terms. This is very important to observe, because when we are saying that the government operations are not kind of interfering with the way the domestic economy operates, is this line that we are looking at. But what drives this? Ordinarily, we should see that when government spends, there should be money going into the economy. But in the current circumstance that we have, is that much of that spending goes to debt service, which means that it's a leakage from the system. And then you have a build-up of arrears, which means that there is no circular flow of income in the economy. And that's what we are saying, that we need to address this, because if it continues, it means that the domestic economy is being starved of the resources that it needs. Now, when we buy foreign exchange from the market, it means we are giving kwacha and taking dollars, which is this 1.6 billion. Now, that adds to that liquidity to the market. But what we are observing, there was tight liquidity that was not sufficient to bring the interbank rate down. Other areas which contribute to this, you can see the open market operations, point 2. Now I may say why that when I'm saying that we are not doing offsetting measures. This is a dynamic which goes on in there. There are activities which we do short-term, and there are activities which we do long-term. Again, because of the COVID challenges that we observed, we introduced some flexibility in our open market operations, that we could undertake operations spanning a period of 90 days instead of just overnight or at most 1 week. So obviously that interaction did also put some money into the market, but obviously not big enough to make the rate move. So this is how we use this. Okay, the other one to look at is the net government securities influence. It means that we are withdrawing instead of putting. As you see later on, we see that there were shortfalls in subscriptions in the government auctions of government securities. And here we are on the government securities side. What you see here, this is the subscription rate. Look in Q4 and Q1 2020, 91.84%. That's a decline. But the decline is worse on the bonds. These are treasury bills, these are bonds. Again, here, just for those who may be wondering what is the difference between treasury bills. Treasury bills are money market instruments for up to 1 year. We offer them 90 days, 180 days, 273 days, and 364 days. But bonds, they are 2 years up to 15 years. That's what we have here. So what you see is that the treasury bills, not too bad, but why is that? There has been a switch. Players in the market are preferring to go short-term rather than long-term because the challenges that I referred to. So that is putting pressure also on the government in terms of raising money, because the government's preference would be to go the bonds way. When you raise money, you don't want to pay it immediately. You want some time to use that money before you pay. So when they come this way, it means there is this pressure now to have this money to pay the maturities as they fall due. So what we are seeing is that both segments were not performing to expectation. Ordinarily, you should have 100% turnout here. So this is shown here in terms of the non-residents. In our market, we do allow non-residents to participate in government securities. So what you will see here, this is the red block here. This is the gross international reserves, the blue line. But what you are seeing is that they were coming down, started to go up, and now they have gone up. We have about 12.9 billion somewhere there of non-resident players. Now, the other thing to mention here, they didn't come directly to this, which is the next part I want to explain. So what we see that the stock of government securities rose to 86.9 billion kwacha from 80.2 billion kwacha. The non-resident holdings increased to 12.9 billion from 8.8 billion, in part due to secondary market purchases. In other words, what we are showing here are the primary. By primary, we mean the first time that these are issued, which we do on behalf of the government. But later on, those who have acquired those securities do sell them. They don't hold them to maturity. So that's the secondary market we are talking about. But there was another aspect here, realizing that we are not able to raise all the money we needed to raise to meet the maturities of the maturing securities and government operations. Then you engaged in what is called private placements. In other words, people don't go through the auction, but they do participate through that window so that you close that gap. So here, maybe just the graph, we didn't provide this graph here, but that's the point that we have. Private placements and the auctions, the two go together. Interest rates. Now, because of the challenges that I've alluded to, it meant that interest rates could not come down in an environment such as that. So what we are saying is that interest rates remained high. In fact, they did increase in virtually all segments. What we see here, this is the differences, average lending rate. This is this dominant color here. Then we have the policy rate, you see where it is. Then these are the savings, I think, which has come up before. But look at the composite treasury bill rate. This is this other one. Then you look at the composite bond rate, see where up. Now, this is one of the things we have been saying, that if these are higher than that or closer to that, then it means that when you and I want to borrow from the financial institutions, they are likely to give you a higher rate. Why? Because they're saying that, why should I pay you more? Or why should I give you money at a cheaper rate? Because I could very easily put this money in government bonds or treasury bills, where I sit, and at the end of the specified period, I collect my return. But with you, there is a risk. You may not pay, you default, or there will be delays in your pay, then I may not be able to meet my obligations. So this is the constant struggle that we are faced with. We say, no, we need to lower these so that this has a chance to become the guide, the one which guides the operations in the market. But right now, that has also been compromised with the advent of COVID-19. So here we just show you the actual movements in these rates in the period under review. All of them did go up during this period. Domestic credit, okay, coming from high interest rates, what would you expect? Obviously, you don't expect a lot more activity in that space because borrowers are very concerned with the high cost of money. But we saw some growth in the credit to the practice by 9 year-on-year. But when you strip this whole thing, you find that much of the growth really was in the government side through these securities that they have to issue to raise money to augment revenues to meet expenditure needs. So this is all that this is trying to show. We have this black line, that's the gross domestic credit growth, and then this is exchange rate adjusted. So in other words, when we try to remove the effect of the exchange rate to see that things are moving normally, then we see that there's a small adjustment from that. That's all this is trying to do. But what you see in private enterprises, small, the dominant one is the government side. That's the story we are trying to share with you here, that this is what is the interplay in the money market space in terms of interest rates. Money supply. The money supply is also driven by and large by the credit that happens in the economy. So if there isn't much credit, money supply also is not growing as fast. So in short, for an economy, a growing economy, you need money to flow because that's what fuels or lubricates the wheels of commerce, so to speak. So what we see here is that year-on-year growth, which is from the right-hand side here, which is this, showed some sharp increase. You may say, oh, that's a good sign. But quarter-on-quarter is this other color. But what you see is that much of that growth was driven by expansion in domestic credit and devaluation effects, meaning there wasn't really much growth. That growth that you are seeing is just a valuation. In other words, it's just a measurement from one period to another in terms of the exchange rate. What am I saying? What I'm saying is that if the exchange rate depreciates very fast, you don't have to have growth. What will be reflected is that change in the exchange rate. So this is why we are trying to adjust for that here in the screen. But what you see is that this seemingly good push up for money supply is driven by that factor predominantly. So that's not really real activity that you are looking for in the economy. Fiscal policy, I did mention that I'll come back to this and share what I think the Honourable Minister has already done so, but just to put it in context for our monetary policy here, what we observe is that the fiscal pressures are expected to heighten in 2020 as revenue performance is adversely by COVID-19. I think the ministry has indicated that they anticipate or they are projecting a shortfall of 14.8 billion in revenues. So this is why it is quite challenging to undertake certain activities because revenue is dropping, and with continued closure of border, continued restricted movement of people to buy things, it means that not much revenue will be collected. Then now, when you add spending pressures, we observe that could actually lead to a higher deficit than was originally planned. And we see that these spending pressures are also made worse by the depreciation in the exchange rate. More so debt service and imported commodities. So the fiscal side is under severe stress. I showed you that the subscription rates are also coming down. So where does the government raise the money? That's the challenge. What you see is a growth in domestic arrears because they are not able to meet the invoices as they are presented. Foreign exchange market, I also mentioned that come to the exchange rate matter here. What we observe is that during the first 2 months of last year, of this year, sorry, the exchange rate was relatively stable. But I think you have to also remember that towards the end of last year, we had other pressures in the exchange rate, foreign exchange market, notably in November going into December, which prompted us to take some measures of raising, for example, the statutory reserve ratio in December so that we could rein in some of that demand which was going into foreign exchange. So that plus some other measures that we took gave us this kind of breathing space in terms of the exchange rate remaining relatively stable in the first 2 months of the year. But the underlying problems had not disappeared. We hadn't quite resolved them. We had high debt service was still continuing, debt levels were still high, fiscal deficits were still quite high, foreign exchange reserves were falling. Then we see that in March, another episode of intensified pressure in the exchange market. Why? One would say that, well, this was already known, but unfortunately, this factor came to play a part here. When people are reminded that even if you are going off the road, if people don't tell you, you kind of at your own time, you get back. But if they tell you, no, you are off the road, I'm sure many of you are drivers, you panic, you try to, that's when you become aware. So that's putting it very simply. When now the publication came that, whoa, these issues are continuing, we are downgraded. Then others took note of that, and that resulted in what do I say, sentiments being adverse and the exchange rate moved. And once it starts moving, it kind of builds on that momentum. So we see that during the period, the kwacha had depreciated by 9.6%. But just that pressure which we saw in March pushed the rate to depreciate by the end of the quarter 28.9%. So you can see the pressure which came out of that. Now, this has to come out somewhere. It comes out in prices of goods, in prices of services, in some reaction of people wanting to charge in dollars so that you, the consumer, is the one who bears that brand. So this is how the whole process tends to operate. So we are showing here different exchange rates. The average for the fourth quarter of 2019, this is the Zambian kwacha and the US dollar, British pound, the euro, and the South African rand. You see that the South African rand has been gaining against the kwacha, because we used to have one kwacha is you get 1 rand plus. Now we are almost 1 rand is equal to 1 kwacha. So, but South Africa has its own pressures. But it must also be appreciated that the stimulus packages which the US pushed, you saw that the Federal Reserve as well as the Treasury, the Congress, they pushed in trillions of dollars into the market. That propped up the dollar as well. So that's part of the pressure we are seeing. To the extent that the US Fed opened its window to some of the other countries who needed dollar liquidity, as long as they had US treasuries, they could access some dollars directly to put into the market for liquidity support. So this is what is going on behind. When you see the exchange rate moving, there are many factors which are at play, but usually it's the supply and demand, which, as you see in the next section, which you look at the external sector, exports also have been coming down, imports have been coming down, but we are not getting sustained supply of foreign exchange in the market. So this is just a graphical depiction of what I explained here. You can see what was happening. This is the shaded area from December. You see what was happening. This is there's kwacha, British pound, but more importantly, this dollar. You see how it has been moving. So this has been moving up, but then it jumps up depending on what happens. Sometimes people will tell you that the exchange rate is like a barometer, which shows you if there are imbalances in the system, it will show up. It's like when we are coming here, if you took temperature, if the temperature is high, it means one part of the body is not in good order, and that's why they suggest go and see a doctor. So next time, I think when you think about that, you may find that you can easily on your own find the answer to why the exchange rate is moving in the manner that it moves. Where was the source and supply of foreign exchange? What you see here, on the right side, this is the supply. The left-hand side, this is the demand. So you see, this is public administration. The blue, that is the previous quarter, and the brown, that is the quarter that we are reviewing. See, there was a reduced demand here, but you see reduced supply as well. We saw foreign financials coming through here through some operations Like I said, these private placements, they would come with the dollars or euro, the exchange for that. But what you see is a story of restraint on both demand and supply side. So as we have said before, what we want is to diversify the sources of foreign exchange. Otherwise, the instability in the foreign exchange market, or the exchange rate, to be more specific, will continue to be something which doesn't leave us. Commodity prices. I think all this time we have been showing this sugar to be constant because we are rounding up to 1 decimal point. So we decided to do 2 decimal points. At least you see a bit of movement, but not a whole lot. But look at copper. Copper Q4 was $58.98. That is $5,898 per metric ton. Q1 came down, you see. So we had these high prices, volume prices before, but it has been steadily coming down. Now look at oil. Oil, it was quite a major drop. In fact, for the first time in places like the US, when you went to fill up a tank, people were actually paying you for doing that because there was glut. Again, arising from this COVID-19, when people are not moving, they are not using much fuel, so they are not buying. So there was excess supply of oil on the market, which led to prices of oil coming down. But they have since started to go up. Now, for us, if we had the means, that could have been the time to perhaps take advantage, but we had those challenges that I referred to. So that's the challenge you have if you already have, I'm using the same word, challenge, but that's what happens if you have difficulties. You cannot take advantage of an opportunity unless you address that problem that you have. So wheat is one which is showing going up. The maize, 167, slightly up, but we have seen that the producers of early maize here, I think they are fetching a lot higher than this. So that again raises issues. If you don't have the ready market, can you be competitive if you are selling at prices like that? So those are some of the things to take account of. Soya beans, this not very different, but if you are talking of thousands of tons, it makes a difference, this change in $2. So this just to share with you what the commodity price market was looking. But the bottom line here, we are saying for our main export commodity, this is not good because it's going down. The other aspect of the external sector is the current account developments. What we see is somewhat encouraging, but it's not very deep because we see that this is characterized by instability. What we are saying that the current account surplus expanded by $122 million, which is 0.5% of GDP in the first quarter, which is quite an improvement from the previous quarter. Now, this was driven by some improvements in exports. If you look at these are the exports, some of the activities there did go down, but more importantly, look at the import side. It dropped quite significantly. So you are improving because something did not perform. That's not the best of situations. You should be improving even when this other is going up. The other underlying challenge here we have is that if among these imports are intermediate goods, it means that it has adverse implications on the production of commodities that need that. So this is something we have to look at very closely. We move on. Gross international reserves. I think this is, you ask a question all the time on this, so we thought we should be clear on this. Our reserves did come down. We had, at end December, we had $1.45 billion. By end March, these had come down to $1.4 billion, representing 2 months of import cover. Now, remember that is reflecting reduced volumes. So that, again, is not what you want. Now, this change could have been larger had we not bought some dollars from the market. On a net basis, we bought $144.2 million. 49.7 million of that was from mineral royalty. Now, this also should kind of push some bulbs in your head in that 49.7 million. This is for the entire quarter. So that shows you reduced economic activity, because we should be getting much higher than that from mineral royalties. So that is reflecting some underlying challenge in terms of what we are getting from our minerals that we export. So this is a graphical presentation of the gross reserves. You see this showing it's been coming down, and the import cover, that's what we are showing here. But you see it's showing going up, but it's because, as I said, the volume of imports has come down. Conclusion. So let me just recap what the MPC did. I think now that you have had an appreciation of the challenges that our economy is facing. We hope you appreciate why we had to take this drastic measure of reducing the policy rate by 225 basis points. Because if no policy action, strong policy action is taken, it means that all those upside risks I showed you to inflation, the downside risks I showed you to growth will materialize. And that means that we are in serious problems as a country. So we are taking this step with the hope that we will stimulate other actions in other areas of policy formulation and implementation. So COVID-19 pandemic is a serious pandemic for which we must come together as a people, work closely, and try to do what is right. But underlying all this, we are saying that we need to have a fiscal situation and structural position which supports these activities that we are doing. We are not asking anything new. The 7th National Development Plan and some other important policy documents have all these actions that we need to take. So it's time to act rather than just say we have a good policy, but if we are not acting on it, then it is not delivering on the objectives for which it was intended. So hopefully, out of this very unfortunate situation, we can see some opportunities to do certain things which so far we are not able to do. So what we are saying is that we have taken this step. This is in addition to the other measures that as an institution we have taken. So we hope that this will catalyze action by other key stakeholders, including yourselves, you play a very important role disseminating information and bringing people together and taking vital information to those who can use it and use it effectively. So what we are saying is that in the final analysis, the committee calls for strengthened collaboration and concerted efforts by all stakeholders to effectively deal with COVID-19 shock and its effects. In this context, the centrality of fiscal and structural reforms that deliver inclusive and sustainable growth can hardly be overemphasized. I thank you. Stay safe. God bless.
Thank you very much, Governor. So there you have it. The monetary policy rate lowered by 225 basis points to 9.25% from 11%. This was done to mitigate the adverse impact of COVID-19 on financial sector stability, economic activity, and ultimately on the lives and the livelihoods of people. At this point in time, we are going to get questions or comments. So if you've got any questions, please state the media house you are representing as well as your name.
My name is Gladys Luizi. I'm coming from the Zambian Business Times newspaper. I have a follow-up question on the MPR. You do revise the MPR, but you don't guide on the top-up interest that the banks can hold. I want to find out if the bank has a plan to issue a target margin that the banks can add, just like you have done with the 10 billion facility. And my second question is on the 10 billion facility itself. I do believe that this facility was created to support businesses and households impacted by COVID-19. And it has come to the attention of many people that this facility is intended to businesses and individuals with existing loans with their respective banks. So I want to find out, does this mean that newcomers, or rather businesses that are also impacted with COVID-19 but do not have existing loans with their respective banks, cannot benefit from it? Or is there any other way that the bank will ensure that such businesses also benefit? Thank you.
Good afternoon. My name is Logic Lukwanda from Phoenix FM. My first question, I want to get your comments surrounding what is happening in the mining sector. I'll bring to your attention, for instance, Mopani Copper Mines has decided to put the Kitwa and Mfulira mines on care and maintenance. And just today, the Minister of Finance and other ministers that are on the copper belt, the last meeting they had this afternoon ended in a stalemate. It's like the mining company has put their foot down. So if this happens, plus other mining companies that have been complaining of operational challenges, what do you think will happen to foreign exchange earnings? Looking at your presentation, you did indicate that that could be the last thing you wish for, a downward trend of foreign exchange earnings. And then my next question, you mentioned that we are likely to see a relief in terms of the surge of the inflation upward due to the expected lowering or downward trend of the food inflation. To what extent do you think that will affect the inflation? Thank you.
My name is Natasha Sakala from the News Diggers newspaper. My first question is on the IMF. Considering the Minister of Finance did state that the country's debt is currently unsustainable, hence us not qualifying for the COVID aid from the IMF. From a monetary aspect, do you think that we could get an IMF program as a country, considering, especially in terms of the balance of payment support? And then my next question is in line with the 10 billion facility that was created by the Bank of Zambia. I just wanted to find out, to what extent is how good is the subscription at the moment? And also, what challenges do you feel is causing the low subscription, as has been hinted by some sections of society? And also, from the past, before the monetary policy was revised today, it was advised that banks offset the money at least 17.5%. Do you think this is also a factor that is causing the low subscription that has been reported?
No, thank you very much for the questions. As was indicated at the beginning of the meeting, I am here with the other colleagues, so I'll ask for some of these for help for them to shed some light. Let me start with Gladys' first question over the margin. You see, as a country, we have gone through a number of different systems. We had, for quite a long time, fixed exchange rate system. We dropped it, brought it in some other way, but it didn't work for us. We also had an arrangement where interest rates were fixed. There was even directed lending, meaning that if you were in a particular sector or segment, the suppliers of credit were directed to give credit to those individuals. And the result was also not a very good one. You also recall that arising from some of that, we did set a credit reference bureau to address what we call the credit culture, which was unfortunately not favorable, where people would get loans, but they would interpret those loans as if it's a gift and they don't pay back. So we found ourselves in a tight situation. Not far from to date, we had from 2012 a situation where we had a cap on interest rates, which cap we only removed in 2015. But it is the reasons for removing that I think are important in responding to your question. One of the things, yes, it looks nice when you say you get the money at a low rate. But remember, the bank is also an institution which has costs, and it has your deposit if you are a customer. So if it falters, or in short, it fails, it means that people's money is at stake. More importantly, if the bank fails, it means that the taxpayer also gets brought in, because the thing would be that you can't really let people lose out completely, so the government will be again pushed to find money to pay depositors and so on and so forth. So you have this complication about financial institutions. Now, when we removed that cap, what was observed is that unintended consequences. Credit actually dried up. We saw some of the financial service providers actually go out of business because they could no longer make ends meet. So it reminded us, sadly again, that fixing rates does not quite work. Another thing to take into account is that when you fix the rate, for example, for businesses, you are all faced with the same risk, when in fact not. We all have different risk profiles, and well assessed, the pricing that we get should reflect that risk. That's why we are being very focused on insisting on the Credit Reference Bureau that they should not just focus on getting negative information about people whose information is submitted there. It should also include positive information. If you pay your facilities on time, you have never delayed, you pay on time, in early, that should work for you. In fact, what has been observed in some of the countries, what people fight for is to have a good credit rating, because it means that they can go and get some money. That's why when you look at 2008, 2009 global financial crisis, the subprime, that was the anger. People were expressing that this information was hidden, and the people who were really not credit worthy were getting this money, and led to the collapse of the financial system. If I may stretch that a bit, I think the reaction of countries that we are seeing currently with respect to COVID is also informed by the experience of 2008, 2009, that if you delay taking action, you are going to end up with a worse outcome. So, I've gone a bit long on that just to give you the context. When we set the MPR, the idea indeed is to persuade the banks to use that as the reference rate. But if you look at the chart I showed you of interest rates, I'm sure you see that the yield rates, for example, from government operations, for bonds, the composite rate is almost about 30%. When you look at the composite rate for the treasury bills, is about 28. Look at our policy rate. Now it has even come down to 9.25. Now, I mentioned in the presentation, if you are a business person, what would you do if you have the opportunity to put your money where you earn 28% or give it to somebody at 12%, for example? Clearly, if you are a company, your board of directors will fire you if you put at 12 instead of 28, because you are losing money. So this is the challenge we have. We have had some structural reforms to try and push that the wholesale window becomes the dominant source of funds. What do I mean by wholesale window? The wholesale window is the Bank of Zambia window, where institutions get their money at that policy rate plus a margin that we apply. That way, if that's the dominant source, then that impact will be felt in the market. Let me also clear the air on the 17.5 that has been said that it is fixed. I think people did not quite read properly. Maybe I think it's an indication to our colleagues in communication that maybe it should be, the print size should be high, because it says that if they were to pass on the benefits by charging 17.5%, then they would get some benefit. It is not saying that we have fixed the rate at 17.5. We are encouraging them to do that. And if they do that, then we incentivize them
with more access to funds. The reason why we are not fixing the rate is what I said earlier on, that there are more undesirable implications of fixing the rate. But we are pushing all those who are applying to access the facility, the 10 billion, to demonstrate to us what benefits they are passing on to their customers. If we are not convinced with that, then we will not release the money. And if we release the money and we find that they don't follow through on that, they will have to pay it back. And since they are institutions that we supervise, the rules of the Banking and Financial Services Act sanctions will apply. So that's the setup now. Now that the rate has been reduced to 9.25, obviously there has to be some adjustment to take account of that. Now, the 12.5, which was the rate before this adjustment, if you compare it to other rates in the market, is still a much lower rate, and that's why we are saying we need the benefits passed on to the customers as well. This brings me to your second question of, is this facility for existing customers only? No, it's supposed to be for existing and new customers. This money is being accessed from the bank, the central bank that is, for own lending to players. That's the terminology that we have used. It also can be used to restructure existing facilities. We have heard that some are saying, no, it's only those existing. That's not the purpose for which this has been said. Remember, we are faced with this pandemic, so we want to invigorate economic activity in our economy. If we don't do that and just focus on those who are already indebted, that's not going to help us meet that objective. So I hope you can engage now more aggressively with your financial service provider that no, you heard it from the Bank of Zambia, it's not just for existing, it's also for new players. So they may be saying, no, maybe you don't have information. That's a different matter, but it shouldn't be said that it's only for existing customers. I hope that answers your question. I'll ask Francis maybe to say something related also to that facility, 10 billion, the demand so far.
Thank you very much, Governor. Yes, perhaps just to add to that, I think one of the issues which may have, given rise to some of the confusion which we're seeing is that when we set up the facility, we are lending this money to the banks, but they have to give us some collateral. Now, to ensure that the banks could really access the facility, we said typically when we lend to banks in other operations, the governor was talking a bit earlier about open market operations. This is the normal lending and borrowing which takes place between the Bank of Zambia and the commercial banks in the money market. We usually use government securities as the underlying security, which the underlying collateral. But for this facility, we said we want banks to be able to lend to a lot more people. So we said, well, you can use government securities, but you can also use your loan book. So you can come to us and say, well, I've got this loan book. Can I use this as the basis collateral to borrow from you? Now, so we have quite a wide set of collateral which the banks can use. That's number one. Now that to define that collateral, which is there in the terms and conditions, we said, we want you to only bring or use loans as collateral which are pass, they're good loans. And so in that sense, the collateral which the banks were meant to use were meant to be good loans. And I think we had a cutoff date essentially of December 2019. So I think this has been kind of conflated to kind of say the central bank is saying you can only use or give loans to current customers who we have. No, we have not put a constraint on the commercial banks on who they can lend to. We have simply said, when you borrow from us, bring collateral. We have also said to them, we want to encourage people to lend into 4 key sectors that the government has identified, and which I think everybody accepts are important: agriculture, manufacturing, we want to go into energy and tourism. These were the sectors which everybody understands are important for diversifying the economy. So we said, even there, we just said 60% of the funds will dedicate to businesses in those areas. And they can be small businesses, they can be big businesses. But we said 60% will go to those. The other 40% can go to the other areas. So those are really the constraints which we put on the facility. But I know we do keep hearing this feedback from the banks. We haven't put other constraints there in terms of who they can lend to. There was an issue raised, I think, is it Natasha? How is subscription? Maybe I could just jump to it. That was related. So yes, we're hearing some challenges around take-up of this facility. Maybe I should just give a bit of background about how we came to this. We really began discussing this thing quite some time before it was finally launched in April. And part of those discussions were with the banks through the Bankers Association of Zambia. We went through the terms of conditions, we went through what the possible challenges might be of this facility, and there was some give and take. We also had discussions with an association which deals with the non-bank institutions. So the ones typically who lend to the small SMEs, the microfinance lenders. And again, we went through with them and said, look, this is what we're trying to do. And they also came back to us and said, there are 1 or 2 things you're doing here which we think might be challenging for us. Can you change? And we tried to accommodate them. For the non-banks, we said, okay, your collateral, maybe let's give some leeway so that you can actually access the funds. So that process took a bit of time. And I think, as we've seen afterwards, even after we launched the facility on April, I think it was 15th, there was some banks coming back to us and saying, what does this mean? One area where I know there's been some back and forth is, we said to them, look, we don't want a situation where you borrow this money at 12.5 at the time. And you simply say, well, treasury bills, as governor has said, or government bonds are at 30%. I'm just going to put money in there. Or I'm going to put it in foreign exchange. So we said, those two, we want you to lend to businesses or individuals. So because of that, we said, look, we're not putting caps on you, but once we approve, when it comes to disburse, we just want you to show us, if I've borrowed money from you at 12.5%, what am I lending to? My customer. And so we said we wanted to see that so that we are comforted that, in fact, the businesses and individuals who are the people we want to help, in fact, who are the people we need to help, actually get the benefit. So that has also created, I think, some back and forth in terms of how quick the facility has moved. But in terms of specifics, so we've had up to date something like 3.2 billion in terms of applications which have come to us. We have now approved essentially about 1 billion kwacha to be dispersed. And that 1 billion now, we're just going through that position of, can you show us what benefits are going to come to the customer, so that once they agree with us, as governor has said, we can monitor later on and say, okay, in your normal reporting, if you have not put that benefit to the customer, we will be able to come back and see this benefit hasn't gone, and would be able to take the appropriate action. So really, that's in terms of the challenges and other issues. That's really where we are with the facility.
Thank you very much, Tiju. Just an additional point, since this matter has been raised, that this facility is available to everybody who can meet the requirements. It's not targeted that this one you exclude. No, it's an issue of do you have the requisite collateral. Now, as we introduced this facility, there were other changes that were made through a government gazette notice on provisioning and classification of assets, which tries to create some leeway for people to have different types of collateral that they can provide. And previously, we used to recognize this for a year. We have extended that period to 5 years to give space to the players to make adjustments. So I think there is confusion, we understand, but I think as media people here, we hope you can help us to explain this. If there is one aspect you don't understand, we are very ready. I think before the start of this meeting, there was another animation which was playing to try and explain this. One thing also must be recognized, is not a tool for everything. We need other instruments to meet other specific needs. But the pressure has been is if this can operate for each and every aspect. That's not the intention, and the name suggests is targeted medium-term refinancing facility. That targeting may be interpreted in two ways. One, which the DGO has explained, that we have a key focus on the sectors that the government has recognized as being priority under the 7th National Plan. Two, the targeting also is institutions which are under our supervision, meaning institutions which are governed by the Banking and Financial Services Act, because that's where we have the lawyers will say the locus standi, that's where we have the powers to administer that. So, if you followed carefully, the challenges that our country is facing right now has introduced severe constraints to the fiscal side, which ordinarily would have been the source which comes up with another type of money to meet those other aspects. But we recognize the challenges that we are in. And when we came up, as DG was saying, with this facility, we had to look at our own circumstances here, not just cut and paste from other places, because we have to do what we think can work within our situation. So it may be faltering at the beginning, but I think as a people, if we want to make progress, I think we have to start with one step. What tends to frustrate development is each time you are faced to take a step, you are looking for things you don't have. What about looking at what you have now and start with that? Because as you move, certain things become clearer and you can make adjustments which can make it better. But in our situation, we see that people, they will start by saying, no, I don't have that, so it can't work for me. That's not the way we must approach life. COVID is real. It is devastating and it's going to debilitate us if we don't seize the opportunities that are before us. We are not going to emerge as strong as we should. Now, Logi Chikwanda, is it asked the issue on the mines? We appreciate the update on the discussions which the ministers are having there. But I think for us, it's the question you raised on the foreign exchange. Obviously, you are right. I mean, that's a given. If that player or the players in the mining sector are not operating and getting the foreign exchange, it affects our economy very adversely. And again, we come to the issue of the sectors that the government identified for diversifying our economy. Zambia has the great potential to diversify its economy. Agriculture, we can, if we really put our mind to it and attended to all the challenges that it faces, it's a game changer. Because for agriculture, you have many positive aspects that spin out of that. You can create employment, you get food security, you get nutritional. So all those are important aspects of the SDGs. And gestation period for agricultural projects is not as long as in the mining. And the outlay required for certain activities doesn't amount to that. So I think we have to really seize the opportunity. Now we have seen some of our people who have favorites of imported items, they are not coming because their borders had been closed. So what happens? This again is an opportunity for us to start producing some of those locally so that our economy can diversify. By buying imports, even when we could produce here, we are exporting jobs. And we wonder why we are not having much employment. So for sure, if that situation is not resolved, it does not portend well for our foreign exchange earnings. And I think that's why His Excellency sent the ministers there, because of the importance attached to that sector. So we really pray that they will be able to come up with something to get us moving. Natasha's other question was on the IMF support. Yes, the minister, I think, was very clear. If you are able to, which I think you are, go to the IMF website, check on low-income countries and the facilities that are available. All IMF facilities have a condition that they can only provide support to a country which has a sustainable debt situation. Or if it is not in that state, at least it must have a credible plan that will bring that to sustainable level. Those are the conditions. I'm not dreaming them up. They are there. And Zambia and 188 other countries are members of the IMF, and those are the rules through the institution. Because the money they fund, the IMF lends, we call it fund for short. It's money collected from members. Zambia, as a member, we have a quota there, which is close to something like 490 million SDR. That's the quota. And our quota, Zambia, is quite big. Actually, for our size of the quota, we are not flexing our muscle fully. Zambia, when we joined the IMF in 1965, our economy was relatively strong. So in the Southern African region here, in terms of size, Zambia is third only to South Africa and Angola. Now, we are not exploiting, and over the years, with the decline in the growth that we are talking about, our economy has been shrinking, and we are not benefiting from that advantage that we have. So I think it's about time we realized our place in the global setting and play at that level. So that's the challenge we have, and that's what the minister has been saying, to work on getting the debt to sustainable level. That's the key requirement for us to be able to work and get balance of payment support that we are talking about from the IMF. Now, sadly, international financial architecture, the way it is that the multilateral institutions, you see you have the Bretton Woods institutions, which principally is the IMF and the World Bank. But we have our own institution, also the African Development Bank. They all look up to the assessment of the IMF in terms of giving balance of payment support. These days, even especially after 2008 crisis, even project funding is now being caught up in that problem. When the World Bank comes and assesses us this, if the IMF doesn't endorse that the macro framework that we have is good enough, they will not proceed to provide balance of payment support. Equally, the AFD would not. But these are rules which we set, which are very unfair, and you see, one would have thought that when a country is in a problems, that's when actually you get assistance. Unfortunately, that's not how international financial architecture works. You are expected to be strong enough so that the support that you are being given can be put to the purpose for which you have got. So the fear is that if your debt is unsustainable, you get that support. Funds are fungible. I think you have heard that terminology. Money is money. When you put it in the pot, you can't isolate that, no, this is for this came from this. So the fear is that that money will be used to other purposes other than the purpose for which you borrowed. That's the basic reasoning which is there. So we have, and we know this, so we have to work on that in a manner that we get those things in sync and we can get a program. I think we have had also some fears, some people have expressed that no, when you get the fund, there will be all these things. There are many countries which are on fund programs which are doing what they want to do. I'll give you the example of Ghana. Ghana is on a program. Ethiopia is on a program. Tanzania, Rwanda, all these have programs with the IMF, the World Bank. In fact, if you look at the World Bank, Ethiopia, Tanzania, Kenya, they have big access to that institution. But they are continuing to do what they need to do. So I think that fear, we need to tame it and get the information that is right. So I hope that helps to explain that thing.
Sorry, Governor, I think there was just one question. I don't know whether this was from Logic on inflation, food inflation dropping. I think with food inflation, if you just go back and look at maybe maize prices or even meal prices, if you went back to say 2017, January for example, what you'll find is that with food prices, when you have a very good season, and especially if you have two good seasons, you'll find that the price swings, which are really seasonal, can be very, very pronounced. So if you look at maize prices, for example, in January 2017, I think between January and something like July, they were rising by between 15 and 20 well, 10 and 15% on an annual basis at that time in 2017. And then between totally July 2017 and July 2018, prices were actually falling. And at the height, they fell by something like 50%. And then from 2018, we began to see a rise in prices. And you can track these in terms of what was happening to the agricultural season and the weather at that time. So food does exhibit some pretty big swings. And so if we do get a good crop, that can happen. You can definitely see food prices dropping and helping us drop overall inflation.
Thank you very much, Governor and Deputy Governor. We are going to take a last round of questions because we have actually exhausted the time that we were given by the Zambia National Public Health Institute. So we are going to get a last round of questions.
If the SME fails to conclude with the financial institutions that they engage in accessing that loan, is there a way given that they can still come through to Bank of Zambia and get more information from you? Thank you.
Governor, I wanted to get your update regarding the preparations to house gold and what are the quantities that you're looking at with the mining company. And the last question, if you could also update us regarding the performance of the commercial banks as regard to the COVID-19. Thank you.
Governor, my name is Darius Jonia from Diamond TV, and I have two questions for you. One, we have a number of stakeholders actually saying that the reduction of the MPC rates by 225 basis points at once is huge and may actually result in shocks in the economy. We'd like to find out why, as the Bank of Zambia, you did not make this reduction in the MPC rates in a piecemeal manner, let's say 100 basis this time and 125 or 125 basis points at the other time, just to ensure that there are no shocks in the economy. And my other question, given how committed you are as governor in ensuring that the Zambian economy remains afloat despite its several challenges, would you say that as governor you sometimes feel frustrated by the lack of maybe fiscal discipline on the part of government, where they spend recklessly on things that are not even budgeted in the national budget? Thank you.
My name is Hope Umsola. I'm coming from Man FM radio station. My question is, looking at the banking system, it's like they've been having difficulties in giving capital to most businesses. So I was thinking, could this be related to maybe having too many foreign banks that are not serving the interests of Zambians? And is the bank considering putting up a policy that will promote community banking? Then my other question is about the trade surplus that the country has continued to record in the past 2 months or so. What is the bank doing to ensure that the country continues to record a trade surplus even after COVID-19? Thank you very much.
Thank you very much for this round of questions. Indeed, thank you for recognizing our mantra, which is time to act. You are very right. I think one of the reasons why we agreed to, for example, also to have this briefing that we are having is really with the expectation that the information will be carried far and wide by yourselves, by your colleagues in other institutions. So at least indeed for those who have access to technological tools This particular session is being aired on Facebook, and I think is Zambia National Broadcasting Corporation, with a view to go as far as where they go as well. But of course, that's not enough, as you have rightly pointed out. So we have to use every means that we can. For the farmers, at least for those who are members of, say, the Zambia National Farmers Union, which, by the way, it has both small, medium, and large-scale farmers. They do have a network of representatives across all the 10 provinces. So a week ago, actually, we had an engagement with them virtually, and save for 3 provinces where there was a connectivity challenge, representatives they are the ones who represent those particular areas. But indeed, that's not enough. We have to go out and partner with other players. We do also have this financial redress, which we do in all the 10 provinces once a year, but we are saying that, I mean, it shouldn't be an event, it should be really something which happens throughout the year. So we are looking for partners to help us disseminate that information. So we hope we can count on you also to do that. We have spoken similarly to our honorable MPs when they appear before their committees, that they too can help to disseminate some information. So we are preparing a number of pamphlets ideally they should be also in local languages so that other people who can't understand and read English can be able to access them. So they say a mammoth task, but which working together, I think we can accomplish. Schools and the other kind of organized groups would be that. So we are open for suggestion. If you do have some, please do not hesitate to approach us. Bessie and their team would be more than happy to hear you out, what suggestions you have. So all I can say, we are relying on you also to send that information, be our ambassadors. Now, the SMEs not being able to access the facility, can they come to the Bank of Zambia? Sure, for information anytime, we are available to do that. But what we are not equipped to do as an institution, which others think we should be, we are not in that to lend directly to individuals. That's not our role. There are other specialized institutions which do that. So there we won't be able to be able to help, but we can indeed provide as much information as one needs to equip them to negotiate effectively with the financial service providers, or even on how they can look at things from a different perspective. So that we can pledge to you that we can do, providing information. Nancy, which was also followed up by Natasha on gold purchases. I think we had even a press query just the other day, which basically...
It was from the Business Times.
Yeah, so the issue is that we reached some advanced stage in terms of negotiations with the potential supplier of that gold. So that process is underway, but we don't know whether it's the issue of COVID-19 which has kind of stalled the process, but we are still following up to see that we even got to the stage where we shared a draft contract. We also undertook consultations on how the gold that they provide, because to keep gold as a reserve, you have to have a certain level of purity. It must be high to be a bullion. So it needs to be further processed. We have all looked into that, and we are ready in that respect. So where we want is to reach. And now, as to the quantities, that too is something which we have yet to agree on with the would-be supplier, how much they have. Now, we are hearing from the Minister of Mines that there are new prospects for gold in northwestern province. So indeed, we don't know what the economic quantities there are, but it could very well be, if they are substantial, there are countries which are reliant on gold as their main export commodity. And you see gold, unlike copper, you sell it per ounce. So, and I think the last time I checked, the price of gold was going up. It's in excess of $1,000 per ounce. So you can imagine how much if you have even just a kilo. That's a lot of money you can have. Now, not to mention a ton, but usually people don't have tons of gold. It's in kilos and all that. But that's a prospect we are surveying, and we do really appreciate if it takes off. Now, commercial banks preparation with respect to COVID. I don't know, did you want to comment, or Director Bank Supervision?
Thank you, Governor. I think I'm going to ask Director Bank Supervision to comment, but we had done quite a lot of work with the commercial banks leading up to COVID in terms of what measures should be taken, how we were making sure that we were complying with the government's health directives as well. But Gladys, perhaps you can.
Sure, as the DGO has indicated, we've had a lot of conversation with commercial banks in terms of preparedness, in terms of how they respond to COVID with regard to their operations. And in many instances, they've been encouraged to ensure that they invoke their business continuity plans whenever they had cases of contact with COVID customers, but also just to make sure that their clients are also protected. But also what we did was that through our conversation, we agreed to revise the working hours for the banking sector to just reduce the amount of hours the members of staff actually exposed to the public. And I think for those that have been following the different measures that we have been putting in place as a central bank, you must have come across some circulars or some circular letters that we sent to the commercial banks revising their working hours from, I think, 8:30 to about 14:30, from Monday to Friday, and then Saturday from 9 to 12 hours. But for those that were able to continue as usual, they were also allowed to do so. I think that's what I would indicate on COVID preparedness.
Thank you very much, Gladys. Hope also raised some questions on do we have too many foreign banks? What are we doing to promote community banking? Too many foreign banks. This is a question we have heard before, but we want to entreat you to the following. Back in 2012, the bank decided to raise the capital of banks. And in so doing, we created 2 tiers of banks. We had what we called local banks, which at that time needed to have a capital of $20 million equivalent in kwacha. And foreign banks, which were to have as a minimum capital of $100 million. This was with a view to promote our local financial sector, so to speak. To date, we have challenges. Some of the foreign banks opted to become local banks, meaning they were willing to give up 51% of their shareholding to local players who were interested and they had the capacity to take that. The experience is saddening because we gave time for these to work out the modalities. It has not translated in getting local people take up possession of those shares. We have no restriction as a country, institution. We have what we call open banking, meaning whoever applies and meets the requirements, they can open a bank. But let's face it, Zambians, I don't think we are very strong that we have had a few who had tried their hand in banking, and the results haven't been very sustainable, sadly. So that arrangement is there as I speak to you. Some of those foreign banks have since come back and said, we are not able to. So we said, no, then you have to put in more money. So, but each time there is a challenge, this issue pops up. That why don't you have? There is no restriction whatsoever. But it's just us, perhaps as a society, we are not really into that space. For whatever reason, we are not able to explain. So if you want, even yourself tomorrow, you come together with your colleagues, you can open a bank, you can open a financial institution. It's very open. So it's uptake, which is the challenge. And indeed, when you have challenges of the type that perhaps you are alluding to, you think the foreign banks are not playing ball. But then again, there are some countries also which just have purely foreign banks, but they still are able to get the benefits that they are seeking to get from those. So this is the challenge we have as a country, as a people. Are we bankers? That's the question we must ask. Because in other jurisdictions, for sure, we have local players who are owning banks. In fact, I recall His Excellency at one time was even saying, even in the hotel industry, you don't have Zambians who have hotels, you have motels, guest houses. How many do we have who have hotels? So that is something we need to look at ourselves. Why can't we do that? One of the challenges we have is we don't know how to work together. We don't respect contract. Even when you sign a contract, the next day you go and put an injunction to say, no, I can't do that. So you can't progress that way. If we were cooperative, this is what other nationalities beat us to. They are able to pool resources together and scale up their operations. We don't. We are loners. If I start something, I want it to be alone. Even if it is not doing well, I will not have the courage to go. If I have the courage, maybe my relations will say, no, you are being exploited. Get out of that. You see them there, you see they are driving, you are walking. Even when you agreed, that's what you are going to do. So these are some of the challenges I think we have to ask ourselves. Why are we where we are? Is it that we don't have money? Maybe not. You see, it reminds me of somebody who was talking to somebody, a non-Zambian, I want to mention nationality, who was complaining, I have no money, but he was driving a very expensive car, parked. He said, whose car is that? It's mine. And you say you have no money. Why are you driving that? Why don't you say, no, I need it, it's my car. We would rather invest in a vehicle which is a wasting asset. It's actually a liability in many cases. But we think that's the wealth. 1 minute you are in an accident, it goes into flames. So these are some of the things. How do we look at this? So it's not that we have stopped anybody to do that. Community banking promotion, we are for that. We are working with the groups that are pushing that agenda. We would like that to flourish and develop. Trade surplus, maybe I'll ask maybe Jonathan also say something here.
Yeah, on the current account or trade surplus, indeed, in the last 2 quarters we recorded that, but I think you need to fully appreciate what has driven that. What has happened in the last quarter is that imports have fallen quite considerably relative to the fall in exports. So if indeed the current surplus is driven by fall in imports, you need to look at the composition of imports. From the data that we have, the fall in imports, unfortunately, is for intermediate goods. So it means that going forward, the manufacturing sector is going to be impacted, and in the long term, growth will be impacted, which is not good for growth for the country. So what will be desired if we are to have a trade surplus is if export earnings are growing. And obviously that cannot be realized if we diversify the economy, and this has been the case over time. Thank you.
Thank you very much, Jonathan. Then there's this question on the adjustment, too huge. Well, you see now, that's the beauty of having different viewpoints. Others think maybe we haven't done enough, should have reduced, and the others will think, no. We weighed in all that. Yes, there's a risk to this playing out in inflation. But if you followed, which I trust you did in the presentation that you have, the economy is in a squeeze. It needs jump starting. If we don't do that and do it later, it might be too late. That's not what we do. We don't want to regret that we didn't do that something. If it turns out that we are wrong in our assessment, we can reverse that. We have the capacity to do that. But for now, looking at where we are, the economy going to -2, it could even be bigger. We may not be able to have that. You see, like a child needs to grow the brain. We heard this, maybe I heard it wrongly, but that's correct. That the first 1,000 days of life are critical for the brain formation. If you don't now nourish that child within that period well, and you come after that, you can give all you want, the nice things, is too late. The stunted brain will have developed. So that's the context in which you have to look at. Where are you coming from? We are coming from the woods, and we need uplifting. Yes, we have even put aside for this particular one our focus on inflation, which is our primary mandate, because what we have seen is that aggregate demand has all but collapsed. So how will we get our economy growing? Unemployment is rising. Schools are closed. They are affecting also the thing. These are serious things which are going on. So if we don't do something big to uplift ourselves from that, and then we come later on, we should have done that it may not be the wisest thing to do. So we went with this, with that feeling that we need to do something, and it's do something which is meaningful. we looked at the different combinations that we could do. We saw that it doesn't make much if we do a marginal kind of adjustment. It will be token. We did that, for example, last time. We're hoping that will be, but we have continued on the downside. So this is the context in which this must be seen. We are alive to those risks, but if they become dominant, they actualize, then we have other tools to use to neutralize them so that we can. But right now, to tell you the truth, our assessment that this economy needs growth, not recession. Because if we don't do that, you see, you are growing at -2 as projected, but your population hasn't also reduced growing. It is growing positive, which means that per capita terms you are even worse off. That's what you should take into account. So that's why we felt that an adjustment of the magnitude that we have done was at this point necessary to offer that impetus for our economy to grow. Frustration. Don't I get frustrated? I'm only a human being. Everybody gets frustrated sometimes. But you have to work through your frustrations. You can't let your frustrations get in the way of doing what you need to do. I think all of us, we have to learn to tame our frustrations. If you are frustrated, someone will go and start binge drinking or something, do something. You are just wasting yourself away. So, actually, sometimes those frustrations are good because they push you to do more than what perhaps you did earlier. So, in fact, if you get frustrated enough so that you act, that's what we would like. Get angry, frustrated, then you act out. You know? So, that's my bit. I know my friends we share, colleagues here, that there are days when you feel what is going on, but that's life. And also as a central banker, you have to be optimistic. Otherwise, you shouldn't be there because the challenges are numerous. That's how I look at life. So I think that was the last question, unless maybe my colleagues, I missed something.
No, Governor, I just wanted to make just a final point on the 10 billion facility, just to really re-emphasize that we have been engaging the private sector on some of the challenges which are coming up and how we can make the facility work better. So that's ongoing, and we think that if we get the right partnerships, we'll be able to make it work.
Thank you very much, Governor and Deputy Governor, for those responses. We have come to the end of our briefing. Just once more.